Gentlemen, please take your seats. Our program will now resume. Welcome, the Emerging Markets Editor for CNN Money, John Defterios.
Good afternoon. I think we could have done a little bit better with the applause coming in, right? Because we have four others that I want you to give a much stronger applause to when I introduce them. So rev up your hands. And welcome to this plenary session, wondering if the era of volatility is over. Is it a black swan era or a white swan era? I actually had a chance to interview the author of the Black Swans, Nassim Taleb, at one point, and I said to him, how do you spot a black swan? He says, don't be ridiculous, because if you spotted the black swan, it wouldn't be the disruption that I'm talking about. But I said, if it happened during the day, or did it happen at night? Because during the day, I could see a black swan, correct? Absolutely, you could. And then I was thinking before I came onto the stage, this is an incredibly prescient time to be doing our session today because, as we all know who've been invested in the financial markets for the last 3 decades, 30 years ago last week, we had the great disruption and the Wall Street crash. And what was the lesson we learned from there? And then nearly 10 years ago, we had the global financial crisis as it was depicted back then, but it was actually a Wall Street, City of London crisis that spilled in eventually to the emerging markets and even the Middle East as we had a correction in energy prices. So what we want to focus on here for the next 45 minutes is it the era of volatility over? Is it behind us because of low inflation, because of low interest rates, because of the new normal, perhaps, for oil prices of $50 to $60 a barrel going forward? Can't be that simple, can it? Surely not. I'm going to bring up a polling question, and I'm just forewarning you because we're going to do it right after we have our esteemed panelists come on the stage. We want to poll you before the panel and ask the same question thereafter as well to get your read on whether your idea of volatility and whether it's a black swan or a white swan era holds true after listening to our 4 experts. And I don't say that lightly. This is a fantastic panel, and I'm privileged to chair it, particularly after all the debates and the plenary sessions we've had over the last 36 hours. It's been absolutely superb. Let's give a warm welcome to one of our hosts here at the FII of 2017. Somebody who just got done interviewing. He did a fantastic interview about the future of Saudi Arabia, His Excellency Mohammed Al Jadaan, the Finance Minister of the Kingdom of Saudi Arabia. Thanks. We talked about having some $20 trillion of assets under management under one umbrella here in Riyadh. That's with sovereign funds and the investment funds around the world, and it's not an exaggeration because I actually went to go chase those numbers so we could put it into our CNN Money coverage, so it is impressive. Let's bring one of the leading players from Wall Street to us, Leon Black of Apollo Capital Management. Thanks. Somebody who we always love to listen to because he has one of those prescient big picture thoughts about where the world is going in 2017 and well beyond some of the forces at play. Mohammed Al-Arian, the Chief Advisor for the Allianz Group. And Mr. Andrew Silito to give us a view from Europe and some of the disruptions from black and white swans. Andrew, welcome to the stage. Thanks. Okay, I did promise that we would do a polling question beforehand. Can we kindly bring that up to the fore? Thank you very much. So, as I suggested, gentlemen, we're going to ask this question before we get started. your mission is to try to change the numbers, perhaps, after they listen to your words of wisdom in the next 40 minutes or so. How much volatility in the market should investors expect over the next 2 to 3 years? We've had a pretty good run in this low interest rate environment, I'd say, right, Leon? It's been pretty comfortable. Mild volatility, significant volatility, and where does that volatility come from? An era of stability that will last forever. Can anything last forever? Probably not. Let's go ahead and vote. We have 15 seconds, please. Terrific. Let's get the results. Aha. This is a fairly skeptical crowd. Significant volatility. Nearly 2/3 of them have said it. Mild volatility, 32% and change. And an era of stability, only 6% going forward. Now that seems a little bit surprising. We have an audience of skeptics. And I think there's a few. I know this is a very young population, 70% below the age of 40 in Saudi Arabia. But everybody remembers the tune. That's the tune from Jeopardy, right? That we got the questions for the... So are we entering a period of jeopardy? That's what the audience is suggesting, Your Excellency. Significant volatility continue. But the question for you is a little bit different because you've convened this crowd of better than 3,000 to come to Riyadh. Your job as finance minister is to present a new era for Saudi Arabia without volatility, predictability, and transparency. Does that all fit into this mix to lower the number as you see it on the radar for the kingdom itself?
Thank you very much for having me, and I would welcome all this fantastic crowd into Saudi Arabia, into Riyadh, and into FII. We are very proud to have been able to have you and have them attend today to present the new Saudi and the new BIF and the new vision of what we wanted to go to between now and 2030 and beyond. I think volatility would potentially be one of the key reasons why we have Vision 2030. Vision 2030 came as a response, amongst other reasons, a response to volatility, to make sure that we have a diversified economy that then reduce volatility. We have a diversified income that then reduce fiscal volatility. We have an enhanced regulatory framework that provide transparency, predictability to the private sector and the economy players, which then leads to reduced volatility and more stability. So the whole initiative that we are living in and the reform that we are going through and the positive momentum that we have achieved so far are key responses to what should we do about the risk of volatility.
Great. So a very quick follow-up before I bring the rest of the panel in, Your Excellency. Transparency. People don't realize that economic numbers in the kingdom weren't as regular as you're putting them out today. So you're doing this with bank reserves at the central bank, foreign exchange reserves, much more comprehensive GDP numbers that come out on a quarterly basis. You want to give people complete awareness of what's trying to transpire here. And that's part of your effort, is it not? Am I correct in saying so?
Indeed it is. And I think if we are expecting investors to partner with us and come and join in what we believe is significant opportunities for us to move the economy to 2030, we need to make sure that we are giving them what they need, which is predictability, more transparency, more information, sharing of data that we are able to give them where it will help their business. It will also give them assurance about what we are doing. It will help us actually work with them and partner with them because, as we have said about 2 years ago, private sector is key driver to where we want to go, and without them we will not be able to achieve what we want to achieve. So we wanted to have all the tools, and transparency is one of them that will enable them to achieve what we want them to achieve.
Okay, let's widen the scope a little bit here beyond Saudi Arabia, beyond the Middle East, which I want to circle back into because it could present a black swan, right, on geopolitical risk, which I think we should check off our list in the next 45 minutes or so here. Mohammed Al-Arian, your views here of why some people have been lulled into thinking that the era of volatility may be coming to a close because central banks around the world have been so accommodative, and they can remain to be accommodative because there's not an inflationary threat. Would that be a huge mistake to feel like we can kind of sleepwalk through the next 5 years and all is smooth sailing?
So it's funny, John, when you said the crowd was skeptical, my reaction was the crowd was realistic.
Aha, okay, good, fair enough.
The Arabic title for this session is actually a much better one than the English one. You know, what is expected and what is a surprise? If you dig below the volatility issue, it's actually quite strange. We've had very low equity and bond volatility, but don't tell that to commodity producers or commodity traders that had enormous volatility. We've had very low economic volatility. In fact, there's been a convergence of growth rates and a convergence of inflation rates, and yet economists know much less about how Western economies function today than they have in the past. They don't understand productivity. They don't understand wage determination, and even Chair Yellen of the Federal Reserve called it the mystery of inflation. So within this concept of volatility are inherent contradictions. And that is a little bit the answer to the question, why do we have it? Because you have people with a printing press in the basement willing to buy assets that have disconnected various parts of the financial markets. They buy bonds, and that influences equities. They don't buy commodities. So low volatility here, high volatility there. And they also influence economic behavior. So yes, the answer to that question, it's mainly about central banks. And the reason why I think this is a realistic crowd is because the influence of central bank is going to go down over the next few years. And therefore, we, in my view, we should expect these contradictions to solve in favor of volatility. And that's why building economic resilience, as the minister said, it's all about building budgetary resilience. Growth resilience is absolutely critical.
Why do you suggest the central bank's influence will drop just by the sheer growth of capital, particularly from the developing world? What do you suggest that?
Because of both willingness and ability. When they entered this world, which was August 2010, Chairman Ben Bernanke said it's about the benefits, costs, and risks. And the longer you stay in this artificial world, the lower the costs, the lower the benefits, the higher the cost and the risk, the higher the collateral damage to the system. And I think they realize that. So every opportunity that they have to exit, they will exit. So the ECB tomorrow will announce a reduction in its monthly purchases. The Fed in December will raise rates again. And they just want to exit this unusual period before we get too much of a good thing.
Okay, very interesting. Leon Black, you thrive on volatility. You make money in volatility, correct? So how do you see this era that we're entering in? And Andrew, I'm going to pose a similar question to you. I mean, you make your money when the cracks appear, right? You go hunting for value. So what do you see in the horizon? I'm not trying to be cynical. It's just reality.
Well, first of all, I want to just thank the minister here and everybody that organized this wonderful conference with PIF. It's great to be part of it.
Have you been to the kingdom before, Leon?
I've been to the kingdom, I think, 5 times.
Yeah, it's amazing the change, let's put it that way.
But this is very special, so thank you.
Terrific. A nice round of applause, actually. It's not an easy thing to pull off for a government, can I say? I've been at Davos for 26 years, and they were kind of labeling it the Davos of the desert. And I thought, is that really going to be the reality? It's like, yeah, it's pretty revved up. 3,500 people with a lot of investment power, shall we say? And Leon's one of them, so go ahead.
Well, you're right. We miss volatility. There hasn't been much in the financial markets that one could label as very volatile now since the downturn 10 years ago. You know, we're living in a strange world where there's a lot of geopolitical volatility, whether it's Brexit or the new administration in the US or North Korea or even just natural disasters. but in the financial markets, you know, the VIX has been, what, at a 10-year low it hit this month. We have record low interest rates out of, what, 50 trillion or so of sovereign debt. 8 of it is in negative territory. We are sitting with markets that are been priced to perfection, both in terms of the equity markets as well as the credit markets, default rates, interest rates, inflation rates. So that has been tough to traverse for those who thrive on volatility. Clearly, what we have tried to do is work with the way the markets had reacted. You know, there's no question that Dodd-Frank, Basel III, Volcker have worked. And the massive deleveraging that came out of that 10 years ago and still continues, especially in Europe today, has also afforded us many interesting opportunities. So clearly, what we try to do in volatile markets is pay less for good assets and leverage them less. So in our private equity business, we have managed in an environment which has been at a 10 multiple of EBITDA in private equity to put out our portfolios, the last one was almost $20 billion, at a 5.5 multiple. And when you put out a portfolio at 5.5 multiple, you're obviously leveraging it less. We're leveraging it about a 3.5 multiple. But that means you have to turn over a lot of rocks. You have to deal with a lot of complexity. We like to say we are willing to trade aggravation for better pricing. And that's what we've been doing. Likewise, in the credit markets, actually what's happened has favored firms such as ourselves because you know, once Volcker and Dodd-Frank and Basel III pushed out banks, prop desks, hedge funds from the market, that so-called shadow banking function had to be replaced. So firms such as ourselves have replaced it. And with the world looking for yield, there's a total thirst for yield today. There's a whole spectrum of different type of credit products that have emerged that have a wide audience and attraction for a world looking for yield. So for instance, at Apollo today, we manage about 240 billion assets. About 150 of that, and the fastest growing part of it, has been our credit platforms. Wow. And it ranges from senior secured instruments, you know, in the 6 to 7% range, up to in Europe dealing with NPLs in the mid-teens. Wow. So that has become a big opportunity for us in a low interest rate environment, and one where many of the traditional institutions basically have been pushed out from because of regulations.
Okay, let me bring Andrew in from Apex Partners. I mean, it's leading off of Leon's point here. We had very high valuations kind of historically right now, from property to equities in the credit market as well, because there's so much capital around. So put the private equity lens on for the audience and suggest where you're hunting right now and how do you avoid a potential blow up, if you will, where the black swan could come from.
Sure. Well, thank you, and thank you. Just echo Leon's comments about organising this great conference. Just before I answer your question, John, I was actually encouraged, like Mohammed, about the response to the audience question, because it's very tempting in times like these to start assuming that this time is different. And I think history will show that mean reversion is quite a powerful force. And so, to your question, how do we invest in a time such as this, when you see valuations at all-time highs, when you see volatility at all-time lows? And it really echoes some of the things that Leon just talked about. I think the focus on complexity, whether it's complexity in the buying process, complexity around asset quality, calibration. So I guess, code for looking for the less loved assets out there. A lot of things are loved these days, but looking for the less loved assets, and then also complexity around what we can do with those businesses. I think private equity can justify its role in the financial system by being able to provide absolute returns irrespective of the weather, if you like. And I think a core part of that is really backing micro themes over macro. And so, whilst you're right that volatility benefits our asset class, I'd like to think that a core part of our job is to take the businesses that the funds acquire on a journey, whether that's around digitalization, whether it's around operational efficiency, international expansion. The key question that we ask ourselves at Apax when we look at a new opportunity is, why are we the best buyer for that business, and what are we going to do in partnership with the management team to really affect long-lasting and sustainable change in that company over a 5-year period.
Great. I want to cover the geopolitical context. Leon brought up a few of the things that have been out there as of late, right? So Little Rocket Man, in terms of North Korea and some of the accusations going back and forth. The referendum in Iraq, and then having Iraqi troops go into Kirkuk. That would used to rattle the oil markets, if not. We saw a blip of about $1, and then the market settled down again. We had the Brexit, a radical shock. It moved the currency, but after a while it settled down. So I'd love to have all four of you suggest, is this a maturation of the global investor, that they digest shocks, and why we've not seen volatility as of late? Mohammed, do you think we've entered a period of time people say, I can digest this. I know what's going to be coming out at the other end of this, so I don't need to be too rattled. The cage is not rattled. I can stabilize quickly.
So the list is longer. You could have put Catalonia in there.
Sure.
It's been an unusually long list of surprises. In some cases, it's because nothing has actually happened. Brexit. People argue hard or soft. It's actually very slow. It's been a very slow Brexit. And therefore, other than the currency adjusting, people are waiting to see what's going to transpire. Another thing is that the market has been conditioned to buy not just the dips, but any dip. The most successful strategy in the last few years is to buy any market dip. And nothing works better, as my colleagues will tell you, than a strategy that rewards you time and time again. You keep on applying it until there's a major shock. So you not just need brazen threats by North Korea or a referendum outcome in Catalonia or in Britain. You actually need a big shock. Otherwise, the conditioning of the market is simply to buy and to fade any such disruption.
Andrew, you had some thoughts on Brexit, I'm sure, being based in London, am I correct?
Indeed, and there's obviously a wide spectrum of views in the UK around Brexit, a good thing or a bad thing. But I think the one thing that everybody would agree on is that it is it's a monumental undertaking that the country is embarking upon right now. And I think just back to your point earlier around when you look at the stock markets in the UK and how they've metabolized that short-term shock around the vote, but around the uncertainty which Brexit inevitably creates. I'm sure there's some opportunity within it as well, but nevertheless a large helping of uncertainty. And when you see the way that the markets have digested that, I think it really speaks to some of the themes that you talked about in the introduction around the wall of liquidity and the backdrop, which I think allows markets to keep moving on. And just as a private equity investor, we're a global fund, so we invest around about 40% of our capital in North America and 40% in Europe. When we look at the UK today, we are continue to look at the UK. We made an investment in a UK exporter about a month or two ago. So it remains a focus for us, but when we're finding ourselves competing with the public market in the UK for businesses, it's difficult. We take concentrated bets in the portfolio, which in turn makes us quite risk averse around binary risks, of which Brexit is obviously a clear one. So when I look at the UK public markets, I think they have metabolized that uncertainty surprisingly well.
Great. Leon, do you want to jump in? I'm going to have a question with His Excellency.
We started Apollo 27 years ago, and over that this time span, there have been 4 cycles. I don't remember anyone that compares to the last 10 years in terms of the power of the central banks. And I think when we talk about geopolitical blips, they are blips relative to the power of the central banks and keeping interest rates where they are and pumping money into the system.
Do I sense a little bit of disagreement with the gentleman next to you here? It says that the power of the central banks will wane over time here?
I'm not saying it'll always be that way. I'm just saying that that is, when you talk about these different geopolitical risks,
they can be managed?
So far, none of them match up to the stability that has been provided by the central banks since the downturn 10 years ago. So I agree with what was said. It would have to be something pretty big. That doesn't mean that, nothing lasts forever. Clearly, we're in the 8th year of an upturn now, and the average upturn has been 5 to 6 years in the past. So one could say we're due if one were just playing the averages. But as long as interest rates stay this low and there's this much liquidity in the world, it's really hard to see a lot of volatility coming back anytime soon.
Got it. Mohammed, quickly, and I'll come back to His Excellency, please.
Yeah, the irony is that if you listen carefully to central bankers, they're warning us. Okay? A few days ago, the governor of the People's Bank of China warned about a Minsky moment. A Minsky moment is when too much stability leads to complacency that leads to instability. This is coming from a central bank governor. Right? So the central bank governors themselves, and the minister was in Washington, D.C., and he can speak to that much better than I do. The officials are saying, be careful. Don't get too complacent about this. It may not last forever.
Okay, very good. Do you feel the same?
I do, and I think...
What did you glean from the IMF World Bank meetings when these discussions then?
I think there was a very simple chart that was shown in one of the sessions over a long period of time, about, I think, 100+ years, and the impact of wars and markets, and it's just a small, a small dip there. So I think I'm not surprised by the reactions of the market, but at the same time, I think we just need to be careful and watchful, and make sure that we anticipate risks and unusual volatility. I think I wanted just to also go back to the beginning, where volatility is actually part of the business. Without volatility, nobody makes money. So people make money out of volatility, and actually that's a normal, natural thing. It's the unusual, unhealthy volatility that is, regulators like me and the central banks try to avoid. It's really excessive leverage, for example, that causes unhealthy volatility. But I think normal, healthy volatility is needed for businesses. Private equity strive, and that brings a lot of investments, a lot of employment to the economy. So it's something healthy.
Yeah, in fact, even corrections are healthy, so you don't have radical valuations in the tech sector, for example, as well. We conducted an interview before we came over today, and 24 hours ago, His Highness the Crown Prince talked about eradicating radical Islam. And I've had at least 4 global CEOs come up and say, that is a shift. That's a green light for me to go in to a moderating, opening economy. And the reason I want to link it into the Black Swan is that it removes a big question mark of what is the climate, what's the environment, is it an open door policy in Saudi Arabia? Why was that statement particularly important in navigating a Black Swan environment in the Middle East, do you think? You were very prescient during the interview. Share it with the audience if you can.
I would want to say, actually, that the statement yesterday summarized possibly what Vision 2030 is about, is that we are open for business and we are welcoming We are embracing our traditions and our values as Muslims, and we will continue to do so. But Islam is not radical. Islam is not extremist. Islam is moderate. And we are saying to the world, we are open for business. We are making sure that our society embraces the real Islam and the real value and the real culture that you are seeing in this event. We will continue to do that. Vision 2030 is not about economic reform alone. It's about economic reform. It's about social reform. It's about changing the lives of the people in Saudi Arabia and the region. Vision 2030 is to put Saudi Arabia as the real catalyst for stability in the region, reducing volatility in the region, being the model in the region. I think all of that brings with it the fact that we are in the center of the region, we are in the center of the Arab and Islamic world, and we need to make sure that we understand that, we value that, and we utilize it for our own good, but also for the region.
Okay, very good. I would be remiss if I didn't ask this question about energy prices, and I'll have you jump in first. Talk about volatility. We were up at 147 at one point for a few hours. All the way down to 26 at the start of 2016. And it appears like an era of new normal, 55, 60 type of thing. Is that what you plan on in this new era, not volatile energy prices? And I'd love to get insights from others on the panel here about the shale production, the other US production being sustainable to keep this level of price that we see today. Your Excellency?
I think two things I would like really to make in relation to this point. One is, again, going to Vision 2030, is basically I want to make sure that by the time we arrive at where we are going, we are very stable, sustainable economy and fiscally, that we can actually weather the volatility in oil price and other commodities. But going forward, I'm not going to speculate on what the price is, but hearing the experts, and they do that very regularly, and particularly in this period of the year, because I'm budgeting for 2018, is that I think the prices are stabilizing and going a little bit up. That's possibly where most of the market experts are. A
little help from Saudi Arabia and Russia.
I don't mind
OPEC,
that at all.
I was going to say, nudging it in the right direction. Gentlemen, Leon, you want to share, do you have money at play in this shale revolution of the United States? And where do you think this volatile market's heading in terms of energy?
I would agree that I think it'll stabilize near term in the 50 to 60 level, sort of between the costs of OPEC and the cost of shale production will be kind of where it has to stay. Having said that, the trajectory should move up slowly, given the needs of on the supply side will come down, and the needs will go up in terms of China and India, as well as other parts of the world. But there could be volatility. The way we have played it is been opportunistically when some of the dramatic movements started a few years ago. We bought a lot of distressed debt in some of the different companies that were over-levered, and we've since gotten out of those and taken some profits. We also have bought in some of the different basins, especially in the U.S., where you could buy up acreage at attractive and then try to cluster them together. And if you can get to size, then you can bring in some wellhead efficiencies there and create value.
Has it played out as you expected then?
It is playing out, but it's not always as we expected. We made a big play in a group called El Paso years ago, and that got whipsawed a bit. And we thought we hadn't levered it that much, but in retrospect, we're still working with the leverage there. We put in a lot of hedges for the first 3 years, which actually stabilized, but eventually hedges come off. So no, it's not all as we expected, but one has to stay nimble, and it's clearly, one of the areas that we have focused on a lot since we started 27 years ago has been in the distressed area, and clearly where there has been volatility, especially in energy, we've tried to take advantage of that.
We're in this midst of the great transition. His Excellency, Mr. Al-Faleh had talked about it, and that Saudi Arabia is embracing the transition to a renewable world at the same time. It's not ignoring, it's not putting its head in the sand, so to speak. But there's been a lot of capital, Andrew, for the last 5 years. I think some $350 billion going into the renewable space. How is as a firm like Apex playing this, and should the minister be tuning in that the capital is rushing to renewables, or can we find an era of stability in energy?
Well, he certainly shouldn't be worried from our point of view, in that we're very much a sector-oriented firm, and one of those sectors is not energy. So, from an Apex perspective, it's not been a big area of focus for us over the last 5 years, and is unlikely to be in the next 5 either. When we're looking at investments where there's a knock-on impact around the energy price, I would really echo what Leon said, which is, we're assuming a period of stability. But really, since I'm a big believer in focusing on your areas of competency, and energy forecasting certainly isn't one of mine.
Mohammed, do you share the same views about this? I would love to get your thoughts on the capital that's going into the renewable space, and what it actually means for, everybody's getting very excited about electric cars, for example, and I think it would be completely ridiculous to think that the electric car appears in the next 2 or 3 years in a very large way to disrupt hydrocarbons. But what are you advising your clients at this stage?
So I think the approach that the Kingdom and other producers are taking is the correct one, which is you hope for stability in the oil market, but you plan for volatility. And it's important to understand why. Stability is when demand and supply balance themselves just right. And that's not the history of the oil market recently. So you mentioned 147. The huge move down from 147 was first demand-led and then supply-led. The move back has been mainly supply-led. And now we have reached this equilibrium where there is supply pressure downwards on oil prices, but there's demand pressure upwards on oil prices. That is a very delicate balance to maintain. I think you will see continuous investment in non-traditional production. So the hope on stability comes from global demand, and that the global economy will continue to recover in a synchronized fashion. But I would be very surprised if we were sitting here in 4 years' time and we ended up by having a very narrow range. I think we're more likely to trade in a wide range than a narrow range.
Okay. I think we should spend 5-10 minutes here on the potential black swan. I think this audience would love to walk away with what we have to be watching out for, right? As opposed to taking advantage of these cracks and why the markets have been so resilient. I don't want to start with you on this one, but I'd like to start with Leon, Mohammed, and Andrew. What most worries you here about a real jolt to the system? Leon, I'm going to ask you to be a little bit brief here so we can get through. This is a key question, though.
Well, I never feel that we have a crystal ball. I feel it's more important that we have an investment model that can alter risk-reward in our favor, come what may. So I don't know what's going to happen there. I don't know whether some European country is going to default, a major one, which will roil the markets. I don't know whether we'll have a nuclear war with North Korea.
That would be quite a shock. That would be quite a shock. Yeah.
Our feeling from an investment point of view is, again, to have a model in place that we can produce superior returns with. So, for instance, in our private equity business, we have three pathways to being able to buy companies at low prices. One is during downturns. We've put now almost $20 billion to work in distressed situations when you have some type of an economic downturn. We find good companies with bad balance sheets and we buy up their debt, and either we get control of them and they turn into very nice buyouts in sectors we know with a bottoms-up analysis, or we make money on the debt if we're not able to, or we deal with complexity, which we've talked about before.
Yes.
Carve-ups, build-ups, or we do idiosyncratic buyouts where we have some type of an edge, whether in the credit markets or in the businesses that we have. So our view is that we never really try to predict.
Nor steer out of it then.
Because we don't know. But we do know, again, over 27 years, there have been 4 economic downturns, and I agree with you, there'll be another one. Sometime in the next 5 years would be my guess. I don't see it in the next few years with low interest rates staying pretty much low, even though we get some warnings. But there will be.
That's pretty interesting, because we've been in the financial crisis, 2008 to 10. 4 or 5 years, you take us to 2022. That is a long, prosperous cycle, Mohammed.
But I don't know. So I don't predict.
Yeah, but you have to prepare.
But we
for
do
it.
invest a lot of capital, whether it's in up markets, down markets, or different parts of the balance sheet, or different parts of the cycle.
No, I got that. That's very clear. Do you think we can have a cycle that goes with stability to 2022, though?
Let me just tell you, Leon, I'm really impressed because John asked a combination of a trick question and a trap. Okay?
I'm not that clever,
and he said,
to be honest with you.
What is the black swan? By definition, it wouldn't be a black swan if we knew what it was.
Yes.
But also, whatever you would have said would have been the headline. Apollo predicts this. Okay. So to be clear, what you're asking us is, what is right now a low risk, because it's in the tail, it's not in the baseline, high impact possibility. And abstracting from geopolitics, I will tell you there are 2 that I worry about a lot. But to be clear, they're not in the baseline, they're in your risk analysis, they're in your various scenario analyses. One is a policy mistake. I have no doubt that the Federal Reserve can normalize in a beautiful fashion, meaning without disrupting market and derailing the global economy. I don't know if 4 systemic...
There's a headline.
I don't know what happens if 4 systemically important central banks, the ECB, the Bank of Japan, the People's Bank of China, and the Fed try to do it at the same time. So the policy error, if you like, would come from taking away too much liquidity simultaneously. Then the other one is a market accident. And for me, the risk I worry about most is not the banks, it's not the payments and settlement system. I think they're really solid. It's what's happening in the non-bank sector. It's the extent to which people who are not as sophisticated as these are willing to give up liquidity. And the proliferation of products, ETF products, that promise you implicitly liquidity instantaneously at reasonable bid-offer spreads, but they're investing in illiquid asset markets. And that, for me, is like a flashing yellow light, that we may find that the system has overpromised liquidity during the good times. Interesting.
Andrew, I wanted to bring up, because we almost alluded to this, there's another shadow world of finance that I'm starting to wrap my head around, and that's the cryptocurrency market and this new era that's emerging behind the scenes, which actually has libertarian roots. The reason I know this is because I just did a big panel on this in Bahrain about 2 weeks ago and had 4 experts that spent a lot of time educating me on this thing. It's a whole nother world. Christine Lagarde of the IMF was suggesting we shouldn't just discount it. And it's going to evolve quicker than we think. How do you play it? How do you see it? Is it a black swan that we should be aware of?
I think if you take fintech in its broader context, I think there's some real positives for the financial system: reduction in costs, better customer service, reaching in some some economies the underbanked. I'm obviously not a central bank regulator, but some of the things that I would be focused on during that is the fragmentation of the roles that are being played in the financial system and ensuring that regulation keeps up with that.
That's not easy, as you go.
No,
it's a whole new world.
It isn't. But I think perhaps, as I sit here today, the area that probably worries me more than that, and again, I think this is sort of the tail rather than the base case, is exactly the skill that's required by the central banks to wean the global economy off the huge amount of money supply that we've seen in the last few years. I'm sure it can be done, but it has led to a relevering of a number of parts of the economy. Interestingly, I think not private equity. We look at the leverage multiple in our last fund, I think it's 3.9 times EBITDA, which is well below the averages of the last financial crisis. But I think as economies have started to relever, again, due to this quantitative easing, weaning the economies off that in a skilled fashion, I think is the to do over the next 3 or 4 years.
Okay, excellent. It's interesting. Mohammed bin Rashid, His Highness, the ruler of Dubai and the Prime Minister of the UAE, said he wants to be the first regional market for the fintech and the cryptocurrency going forward. You're the Minister of Finance, very close relations with your central bank governor. I had a chance to meet in the last 24 hours. What do you plan for in the future in this space? Because it's moving really rapidly. You can't ignore it.
Indeed, we can't. I think we have a new program under the vision, which is called the Financial Sector Development Program, which basically respond to this and wide other things. We are assessing how is our financial sector going to lead us to 2030 and the economy size of 2030 and where is the gap. And one of the areas that we are focusing on is fintech. And we actually believe that technology and fintech is a significant tool that we should be using to support where we are going, while we are also watching at the same time the need to ensure that the regulatory framework is there to assure a stable financial system. I mean, Saudi Arabia, as you know, enjoys one of the top 5 banking systems in the world in terms of stability and strength. We want to continue maintaining that, but expanding it. And by expanding it, obviously, you need to be mindful of the risks, including fintech risks and technology, generally, disruptions.
Good. I have a theory, and maybe it's completely wrong, but Leon, I'd love to hear your thoughts, or Mohammed, on this, that as China rises and its role increases in the world, that I can't see the U.S. kind of ceding the role as the dominant currency in the world, the reserve currency of the world. Is this what evolves as a reserve currency the next 5 to 10 years? You have a cryptocurrency that replaces the U.S. as the reserve currency of the world, and that's a happy medium between China and the United States and these two very large economies?
I have no opinion on that subject.
So that means he's making a lot of money in the cryptocurrency market.
Not my area of
Mohammed, what do you think about this?
We do a lot of bottoms-up analysis of companies.
I wasn't even trying to get a headline, and you ducked me completely. No wonder you're so damn wealthy. I get it.
I'll tell you, this is a very smart man, right? And it always happens on a panel that the moderator not only takes you very close to the line that separates courage from stupidity, but helps you get over it. So let me get over it. The answer is no. Okay?
No, it doesn't.
No. Over the next 5 to 10 years, a cryptocurrency will not replace national currencies and will not replace the dollar as the reserve currency.
Now, that is a headline, so thank you very much. I appreciate it. Very interesting. You want to wade into this, Andrew?
I'm good.
You're good.
I'm surrounded by smart people.
These private equity guys, they're too smart. They're too bloody smart. Okay, let's bring up our poll question one more time, see if we have impacted the debate here at all. How much volatility in the markets should investors expect over the next 2 to 3 years? Bring back that Jeopardy music. I love it. Flashback to the 1970s. Mild volatility, significant volatility, an era of stability. We had 60% suggesting significant volatility before. And the music. Good, I like the little jingle at the end. Let's see the results. Okay. So we went down. You guys did provide some solace here. 56% on significant volatility. Mild volatility will be with us at 43%. And an era of stability. You've completely rooted out that crowd. So we did have an impact on the thoughts of everybody at the panel. Your Excellency, I have a live shot to get to. And I know the traffic. I've got to get over to the Alfa Salia. So if you don't mind, if I wrap 5 minutes early, are you good with that?
Yeah.
I appreciate it, because before I do our interview, I've got to get it turned around and on the air.
Absolutely.
Let's give a nice round of applause to the panelists. Thanks for participating for the field.